Still waiting to go live. Yes, we are live. Hello, everyone. Welcome to Business Learnings. In this video, we will talk about the capital adequacy ratio. And this ratio is in context of the banks. So it is very important to understand what does it mean. And every time you are going to analyze a banking stock, you should always look at its capital adequacy ratio and compare it with similar banks to get an idea of how you know how good the bank is. This is one of the measures to do that. Uh, so in terms of uh, uh, in terms of layman's language, I can say that capital adequacy ratio tells me about uh, how good the bank is in terms of uh, meeting its risky assets. So bank has assets. I'll explain this and it will be clear in a minute. So bank has assets, right? Loans are the assets of the bank. Why? Because loans earn banks money. Banks earn money by getting interests over the loans. So loans are assets of the banks. Uh, Now, there could be various kinds of loans. Some loans are more risky, some loans are lesser risky. Uh, what kind of loans are less risky? The loans which have proper collateral behind them, because if those loans are going to get defaulted by the people who took them, bank can always go after them, and bank can liquidate uh, the collateral that they had put in put in the bank, right? So these are less risky assets, less risky loans. But there are also some loans which are riskier. What kind of loans? Which do not have a good collateral, or with let's say the letter of credit based loans. So these are relatively riskier. Okay. Uh, Now, the capital adequacy ratio tells us uh, if tomorrow something bad happens, if the bank, uh, if a lot of loans go default, a lot of bad loans go default, will the bank still be able to manage its operations? Will the bank still be solvent? So this is the question which is answered by your capital adequacy ratio. Uh, so bank earns interest, right? And it also has to pay interest to the people who have deposited their money with them. Right? If a lot of loans start going bad, and this would mean that the income source of the bank is uh, is not as much as it used to be. So the bank might not be able to give the depositors their interest, or they might not be even able to pay back the money if depositors go to the bank and ask for withdrawing their money. Right? This means that more the money bank has, more the good quality money the bank has, more its ability to absorb this kind of losses due to bad loans. So typically we use the formula tier 1 capital of the bank plus tier 2 capital of the bank divided by your risky assets. So tier 1 and tier 2 capitals are basically the equity capital of the bank. If you take losses, you have your equity is reduced. If you make gains, it adds on to your equity. So higher the amount of equity a bank has, better prepared it is for handling any such risks in the future, and better is its capital adequacy ratio. So while evaluating any banking stock, you should always also look into the capital adequacy ratio of the bank and compare it to what the industry average is. Okay. This is very important to understand. If the bank will be able to service its deposits, honor the withdrawals made by people in future if they come to the bank for asking money, right? So this was all about it. Thanks for watching. Bye.